had no idea really how much I could learn, how much I could grow, and what it would mean to me in my professional career. So I am, again, very pleased to be here. I hope that you will talk to one of the iron professionals in the chapter here, find out more about it. It is an incredible resource for us and for property owners, managers, investors in our current day. I wanted to talk a little bit about this event also with regard to IRM Chapter 85, and just let you know that your participation today, your attendance today, allows this chapter to sponsor 4 lucky professionals at $1,500 each in scholarships for this very incredible education that IRM provides. In addition to that, your participation and attendance today allows the executive leadership to attend our national conferences, learn more about chapter leadership and growth, their own personal growth, and how to just engage, how to grow the industry, how to serve the members within their chapter. So again, I thank you so much for being part of this, part of us, and part of this effort today. It really is very meaningful, and I really hope that you will continue this participation through the year, or at least the interest to find out more, and hope to see you here again next year. We would like to give some special thanks right now to Kristen Raymond from Bynum and Associates for her work on the printed materials and the PowerPoint presentations for this event. Kristen? I knew I'd be saying your name. I told her, aren't I saying your name today? She goes, no, I don't think so. And the committee would also like to express a special thanks to Linda J., CEO for the Bakersfield Association of Realtors, who kindly volunteered her in-house design staff to assist in our marketing and design efforts for this year's event. Please give her a good round of applause. And now it's my honor to introduce your Master of Ceremonies, 23 ABC News' Chief Meteorologist, Elena Rusk. Raised in Sacramento, California, Elena attended California State University, Chico, and graduated with a bachelor's degree in journalism with a concentration in news editorial and a minor in psychology. She found her way to Yakima, Washington after college for a producer position that quickly promoted her to being a reporter. And eventually she moved to Lawton, Oklahoma for a full-time reporter position there. In 2008, Elena completed her degree in broadcast meteorology from Mississippi State University with honors. And in 2008, she moved to Bakersfield to become a morning live reporter at 23 ABC News. So please welcome 23 ABC News Chief Meteorologist, Elena Rusk.
Hi, good morning. I am actually quite nervous. I usually can't see you guys. You're just at home in your bathrobes. So thank you for getting up early with us. We wanted to do a quick thank you for everyone. I know registration was a little messy this morning. We had some extra tables in the back to give you some more knee room. Those were removed, and it kind of caused a trickle-down effect. So thank you so much for your patience this morning. They asked me to say a little bit about what I know about real estate, and that's nothing. I came because I saw forecast in the title, and I got excited. But honestly, I lived in apartments for 10 years. A good property manager can make or break an experience. I started with a property manager here on Ming Avenue, who is actually still one of my dearest friends. She left to go pursue her degree, marry the love of her life, and I had cockroaches a year later. So that was quite the nightmare. Ended up moving out, getting engaged, and trying to buy a house in 2012 which, as many of you know, for home buyers in the medium range market was a nightmare. Our realtor, Jeannie, was a saint. She would get up with us early. She would stay up with us late, take us out all weekend. And after 72 houses, we finally got one with an illegal addition and a kitchen window that will kill us if there's a fire, but we're so excited about it because it scared away all of the foreign investors and we actually got a home. So I just want to thank you all for everything that you do. I know it's kind of an invisible profession that you guys, we see your names on the billboards, we know what you do, but people don't really understand how much it makes a difference in our lives for us to be able to sleep in a nice home at the end of the day. So a big thank you to our dignitaries. We have Mayor Harvey Hall here today. Is he? He's here, I bet. Pam Rose, the Deputy Director from State Senator Jean Fuller's office. We also have Vincent Fong. Hi there. Vincent Fong is the aide to Congressman Kevin McCarthy and a new candidate for State Assembly. Congratulations, that's very exciting. Shameless plug, the 23 ABC News team will be here. I think we'll have Tarek or Henry, so at some point, smile because you're going to be on camera. And of course, Bakersfield, Californian business reporter John Cox. So now it's time for our first speaker. We're going to have, with banking, AJ Anton Giovanni, the president, CEO of Mission Bank and its affiliates. Mr. Anton Giovanni was born and raised in Bakersfield. He is a graduate of Garces Memorial High School and earned a bachelor's degree in finance from St. Mary's College of California, graduated with honors from the Pacific Coast Graduate School of Banking in Seattle, Washington. Mr. Anton Giovanni's banking career began in San Francisco, where he worked with Wells Fargo Bank before returning to Bakersfield and joining Mission Bank. Beginning his career there as a relationship manager, Mr. Anton Giovanni eventually worked his way up the ranks of the organization and is now president and CEO of Mission Bank and its affiliate companies. Please welcome.
Okay, does that work? No? Flip it on. Yeah. Testing. Testing. Okay, gotta get a little closer. We'll see. How's that? No? How's this? How's this? How about now? All right. Good morning, and it's great to be here, and thank you for that introduction. And if you're nervous and you're on TV every day, I've got no chance. So, AJ Anton Giovanni, I've been the president of Mission Bank for about 5 years. I've been the CEO for about 3 years, so we're going to talk a little bit about banking and how that affects the real estate market here locally. We'll also talk about some national trends. Before we do that, a little bit about Mission Bank. We started in 1998 with $5 million in capital. We've grown. We've attracted customers, made loans, and now we're at about $475 million in total assets, and that's about $42 million in capital. We have $300 million in loans. 100% of our loans are for business purpose. So we're making loans for commercial real estate, ag real estate, industrial, office, retail. We're not making loans for consumer purposes. So that's primarily going to be mortgages for your primary residence or your for a car. If you buy a house and you're going to rent it as an investment, then we'll make that loan. But if you're going to live in it, we won't do that. And that's primarily driven by regulation. And we know business banking, we know the commercial market, and that's where we like to stick to what we know. When we go outside of that, we're not as competitive. And the analogy that we use at Mission Bank to kind of make sense of that is we talk about in fast food, if you want a chicken sandwich or a salad or something like that, then you're not going to go to In-N-Out Burger because they only do one thing. They do burgers, but they specialize in that. They put all their energy into that, and that's what they do very well. And so that's what we think about with business banking. So that's just our space, and there's other institutions out there that do consumer banking very well. We'll touch a little bit on consumer banking and mortgages because of rates, but primarily our perspective is on business investment and commercial real estate. Today we'll go over 4 things. The first one is our national economy, and that has a huge impact on interest rates. Interest rates then trickle down and drive real estate in several ways. It's your affordability index for mortgages, commercial and residential. It's going to have a direct impact on cap rates, which is going to affect values, and it's also going to affect your return on investment if you're buying a piece of real estate as an investor. So it's very important. Most of the other speakers up here, we have some great ones, are going to talk about factors that affect our local economy here in Kern County and Bakersfield. And that's very important. That's going to drive a lot of real estate values and decisions that people are making in the real estate market. But the national economy is also very important, so I think it's important to have both. And I'll talk mostly about the national economy and how that trickles down into interest rates, and then therefore is going to affect a lot of things that we're all doing in the real estate space. Last year, if you were here, you'll know that I made some predictions in 2015. And so we'll go back and we'll do a report card and see how well I did. Was I anywhere even close? And then we'll fast forward it to 2016, and we'll make some predictions about what we think are going to happen in the economy and therefore in interest rates and different things in banking for 2016. The national economy, before I get into this, I want to say, as far as predictions, I'll tell you what I think, but I also tell you that I cannot predict interest rates or what's going to happen in the economy. If I could do that, I'd buy an island somewhere. I'd be retired. I wouldn't be here today. So I don't think anybody can predict those things, but we do our best to forecast them. It's an important part of our business, and so we stay in tune with it. One of the ways that we do that at Mission Bank is we follow the Federal Reserve Bank. So if you read the national news, the financial press, you hear about the FOMC that changes Fed funds, which then will change prime rate, Janet Yellen. And in our district, the president of the Federal Reserve is Dr. John Williams, and we're a Fed member. So I was lucky enough, I got invited to a lunch a couple weeks ago with Dr. Williams, and he shared a lot of these views. So a lot of the things that I'm going to discuss are national trends. The information is available publicly on government websites and really reflects what the Fed is thinking. There's a lot of economists out there. That's one of them. I think it might be one of the best, and it's one of the ones that we look at in terms of trying to predict where interest rates are going as far as at Mission Bank. So what's happening in the national economy? First off, GDP, gross domestic product, which is a measurement of all of our spending in the United States, is very positive. We're in the 7th year of expansion, which is kind of hard to believe. If the economy is shrinking and spending is decreasing, then we're in a recession, but we've actually been increasing and spending has been improving for 7 consecutive years. What drives spending? A few things. Employment, we'll talk about, inflation, and consumer spending is 70% of our gross domestic product. So as consumers, we reached $12.4 trillion of spending last year. And as you can see on the chart there, it's been going up steadily the last 7 years. What do we buy as consumers? So what are the big ticket items that you and I and everyone in this room will buy when we're feeling good about ourselves and we want to go out and spend more money? Cars and houses. Okay, so those are the 2 big ticket items. So those are tracked very closely by everyone at the Fed and the economists. So the first one we'll look at is housing starts. Are people buying houses? This will say yes. So we increased last year to 1.1 million housing starts in the United States, and that's predicted to further increase in 2016 to 1.2 million. So compare and contrast, what was it when we hit the lowest point of housing in 2011? 600,000. What was the peak back in 06? 1.8 million. So we're still not anywhere close to that peak of 1.8 million, but we're double where we were in 2011 at the trough. So that's a very good trend and a sign of all the consumers across the United States that are feeling good about buying new houses. We see a similar trend in autos. So in the auto space, last year at the end of the year, we had a seasonally adjusted average or prediction of 18 million cars being bought in the United States, and that's twice as many as what happened during the recession back in 2009. We got down to $9 million. And I know for some of us, we deal with the dealerships here locally as bankers or as real estate agents, and they're seeing that trend here locally where they're seeing housing starts or seeing auto sales have increased and well above where they were a few years ago. So that's another good trend in driving consumer spending. The next thing is unemployment. So we're at 5% unemployment, and the experts say that that is full employment. We can't really be at zero, because even in the most healthy, robust economy, there's natural turnover employees. There's new people coming out of college every month or every certain times of the year that are entering the workforce. So we can't really be at zero. So 5% is considered equilibrium or full employment. So we've reached that, and that is reduced in half. We had a peak of 10% back in 2009, 2010, and so as Americans, we're back to work, which is a great thing for the economy. Okay, government spending is another big factor within GDP. So government spending is up and expected to increase. So I asked myself, is that good? Who pays for that? We do with our taxes. But in the economic world, in that equation, more spending is increasing the GDP. So the government is spending more money. This is on a national level, and I know here in California that's also true. Our governor is proud to announce that we have a balanced budget and that our spending is up around $6.5 billion. Here's something that this is one of those factors where what's happening at the local level may be contrary to what's happening at the national level as far as economic news and impact to us with oil prices. So oil prices are down, as we all know. Locally, that may not be a good thing. I know some others are going to come back and talk, or come up here and talk later. That affects us in a few areas. Our property taxes are going to be way down. It's driven by oil prices. It's also going to affect gas prices. So how many gallons of gas do we consume, or how many gallons of gas do consumers purchase in the in California? You want to guess? 14 billion gallons. So if the price of gas comes down 50 cents, that's $7 billion worth of new spending that we can go buy other things, like buy a better car or buy a bigger house or something like that. So it gives us purchasing power. That purchasing power multiplied throughout the national economy is huge and a very positive effect. But here locally, when oil is down, we lose jobs and things like that. It may not feel that way to us here in Kern County. So that's one of the reasons why we track that national economy, because it's going to affect the interest rates, whereas what's happening locally may be in some cases, or in this case, the exact opposite of what's happening at a local level. Okay, so the end result, GDP, we've had growth, call this steady growth, consistent growth, not stellar. In some cases, we'll be up around 4% GDP. Predictions for 2005 or 2015, because the final numbers aren't in yet, are around 2.5% growth. And for the next year, for 2016, expected to continue to increase to 2.8% growth. So that's what's considered a good number, but not necessarily a really great number. So as far as the Fed is considered, they think the economy is healthy and expanding, and we're on a good path going forward, but not a great path. What are the things that worry the Fed? What are the things that nationally or internationally could cause us to not reach these numbers? The first thing is geopolitical news. If something happens throughout the world in some of these issues or some of these areas where you could have conflict, then that could change it. The other thing is that the value of the dollar is up, very strong dollar, which affects our exports. So it makes it more expensive for other countries to buy our goods, which affects us here in Kern County because of ag commodities that are being exported. So as the dollar increases, that would have a negative effect on GDP and could affect this number. And okay. So all of that is really background for us that we look at and say, where are interest rates going? And so we're going to talk about that next. And really in interest rates, I think about three rates. The first one is the Federal funds rate, which is what we hear about. The Federal Reserve, Janet Yellen, Dr. Williams in San Francisco meet 8 times a year and change that, and that directly affects the bank's prime rate. The second one I think about is the 30-year Treasury. Why is the 30-year Treasury important? Because that's going to affect your mortgage rates. Okay, so everyone that's involved in the housing sector, that's going to be your driver of mortgage rates. And the next one that we track is the 10-year Treasury, which affects commercial mortgages. In the commercial space, we're generally doing 5 to 10-year rates, and so we look at that index for our borrowers. First one, 10-year Treasury. The last year, it's been bouncing around 2 to 3% increase from its very low point at 1.6%, but still well below. Historically, if you look back there to just to 2007, you can see it was the highest 5.5%. So we're increasing slightly, not a whole lot. So it's a very good time to be a borrower. The 30-year Treasury, anyone out there getting a mortgage, is going to be indexed off of that. It's come up a little bit also in the 2.5 to 3.25, maybe 3.5 range. And again, historically, if you look back to the last 6 or 7 years, that's still at a very low point, but increased slightly from where we were a year ago. And so that's going to affect consumers buying houses. Prime rate, too low. That's what we get as banks. So we'd like to see it a little bit higher. You can see that very low flat rate. The rate was, the last time the Fed increased rates was in December. But prior to that, the last time the Fed had increased rates, the iPhone did not exist. So that's kind of an amazing way of thinking about that. When we got that email that the Fed rate went up, and it doubled, the rate doubled from 0.25 to 0.5. So that little bitty little increase at the very end of the chart, that's going from 0.25 to 0.5. So it's still very, very low by historical standards. But it did, the Fed did raise rates slightly at the end of December. Okay. What is happening in rates? The Fed is raising the short-term rate. What happened to long-term rates? You'd think there would be a correlation, they would go up. They did not. So long-term rates are staying pretty much low. So we're getting what's called a flat yield curve where short-term and long-term rates are almost the same. Why are long-term rates not going up? The Fed. The Fed is also controlling long-term rates. How do they do that? They're buying mortgages and treasuries. How many mortgages and treasuries does the Federal Reserve System own? $4 trillion. The Fed has invested $4 trillion and they own those securities. So they buy them, they print money, they go out and buy securities. So that is keeping those rates artificially low. So I'll argue against that. I'd like to see them stop doing that and let the market forces take over. I think that would be better off. But in their wisdom, they think that that's the right thing to do. So it's keeping pressure on those short-term or long-term rates even to stay well below where they might otherwise be in an ordinary market. And $4 trillion, once they stop doing that, they think it'll take about 6 years to unwind all of that. And they'll do it as mortgages pay off. They just will stop reinvesting those proceeds. Right now, as mortgages pay off, as we all make monthly payments and those principal payments are coming in, then they're reinvesting those in more mortgages. And this is what's called quantitative easing. So if you read about that and they say QE1 and QE2, and it sounds really fancy and you got to have a PhD to understand it, it'd be easier if they just said, we're going to buy all the mortgages in the United States, and then we'd know what they're doing. They own, at $4 trillion, they have about a third of all the mortgages in the United States on their balance sheet. What an interesting factor, what's the highest prime rate that we've ever seen? So this is saying prime rate in this chart is at 3.5%. What's the highest that it's ever been? 21.5% in December of 1980. So I hope we don't go that high, but a little bit higher would be good for the bankers. Okay, predicting the future, the FOMC dot plot. So every Federal Reserve voting member puts a dot on this chart where they think interest rates are going to be. So if you look at it, it's kind of the average. And if you look out to 2016 and then 17 and then 18, you see steady increases. So most economists, most people tracking this think that they will continue to raise the Federal Reserve fund or the Fed funds rate, and therefore prime rate will continue to increase somewhere around 50 basis points to maybe on the high side 150 basis points each year over the next couple years. Okay, so looking back at last year and doing assessment and telling myself how well did I do, was I close? Last year, prime rate I predicted would be up 50 basis points. In actuality, it was up only 25 basis points. So we got close. I was being optimistic. And I was also optimistic in the 10-year Treasury, saying that it would be above 3%, and it's hovering more around the 2.5%, maybe getting up to 2.75 at certain times. It's really been staying in the mid-twos. Also thought that real estate borrowers would pressure banks to extend fixed rate loans, and that's very true. Borrowers know that this is a historically low period of time, and they're coming to us and saying, we want a long-term fixed rate loans. And I said banks would reluctantly offer those, so ourselves and our peers out there have been offering longer term and lower fixed rate loans than what we historically have done because there's a lot of liquidity in the market. So the supply and demand of money is shifted to where banks have too much money, they want to get it out working in loans, so they're willing to offer longer fixed rate loans at relatively lower rates. So we were right on those two predictions. So where do we get? What's going to happen in 2016? The crystal ball says, my best guess is that the Fed funds will raise their target rate 3 times or 75 basis points in 2016, and that the 10-year Treasury will be above 4% by the end of the year. That one I'm very optimistic. I don't know that will happen because of the quantitative easing and what the Federal Reserve has said. They're just going to keep buying mortgages. But I hope that will happen because as the short-term rate comes up, if our long-term rate does not come up, then at some point you'll have an inverted yield curve where long-term rates are actually lower than short-term. And that's not good for us because that is one of the highest correlated items to a recession. So historically, whenever that occurs, then it's not a good thing for our economy. So I'm going to be optimistic and say the Fed's going to raise short-term rates and that longer-term rates will also go up. Banks will begin to normalize rates and terms on real estate loans and begin to raise rates, shorten fixed rate periods, and credit spreads widen. So I think the supply and demand balance will start to shift slightly. For the last several years, it's been squarely in the borrower's favor. Good quality borrowers buying good properties are getting very good rates, and I think that will not change a whole lot, but it will start to normalize, and we'll get to a more balanced place sometime in the future. Not totally balanced in 2016, but I think it will start to shift back the other way slightly. So that's what I have. I appreciate it. The committee that puts this on is awesome. They do a great job. I think you can tell that by the people in attendance and the quality of the speakers. And as I said, this is kind of the national look, which drives interest rates, which will trickle down into the real estate market. And everyone else up here, I think, will talk about their segment of the market here locally. So by the end of the day, you'll have a very good outlook for 2016. So thank you.
All right, thank you. Next, we are moving on to multifamily. So we're going to introduce Mark Thurston, the Senior Vice President at Newmark Grubb ASU and Associates. Mr. Thurston began his 25-year real estate career as a realtor for Watson Realty Company. In 1997, he joined Newmark Grubb ASU and Associates as their primary multifamily specialist. Mr. Thurston has been recognized nationally among Grubb and Ellis affiliate professionals with the prestigious Circle of Excellence Award in 2002, 04, 05, and 06. Mr. Thurston currently represents buyers and sellers in over 24% of Kern County's multifamily transactions. Over the course of his career, Mr. Thurston has sold over 7,000 units with a market value in excess of $375 million. Mr. Thurston.
(2015, 2016) Bakersfield multifamily market. Unfortunately, Marlon Perkins and Jim Fowler were unable to lead your safari today, so I have volunteered to be your guide. So if you are ready to go, we will climb aboard our safari vehicle. Remember to keep your arms and legs in at all times, and please do not try and pet the animals. The first rule that you learn when you're on safari is that at some point everything gets eaten. And so for animals, in order to survive day to day, they have to be very aware of their surroundings, and they have to have information on where their predators are located. In the Bakersfield multifamily market, in order to be profitable, we also need to have up-to-date information. So starting here, exploring our data for 2015, we're going to talk about the total sales volume. It was an incredibly wild year last year. We actually hit $134 million, which was roughly a 78% increase over our previous total in 2014. That $134 million is the fourth highest level we have reached since 1990. So pretty amazing year for us. Our next volume is we were up 600 units sold over 2014, which represented a 44% increase last year. Moving into the cap rate analysis, the way that we derive the cap rates is I survey the largest transactions that take place, in which in 2015 we had 8 major transactions occur. We look at those because the income and expenses are readily available. Once I take the expenses, I factor in new property taxes in order to come up with our cap rates. And in our cap rates for last year, they ranged a low of 4.99% to a high of 6.97%, and we averaged 6%. Our fourplex market showed appreciation last year of $10,000 per unit. We ended up the year at roughly $73,949 for fourplexes, which was a 15% increase over 2014. In our 5 to 30 unit segment, I'm happy to report for the 5th straight year we have had appreciation in that category. Although it wasn't up a huge amount, it did go up 6.2% to reach $54,737. And finally, we get to our 31 plus. They had an absolutely huge year last year. In fact, the total sales volume of $80,918, that is the second highest price in the since 1990. So huge year, and that is actually equal to about a 50% increase over the 2014 volume. Looking at our appreciation rates in the multifamily sector, last year we were at 13.53%, which was down slightly from the previous year, but still a very strong number. If we look at the last 20 years moving average for appreciation rates in the multifamily sector, we are now at 8.2% appreciation per year. Moving into our citywide vacancy rate. We started the year at the conclusion of 2014 at roughly 3.3%. By the end of the first quarter, it had actually dropped down to 2.99%, and then it rose up, reaching 4.62% by the end of the year. As far as rents last year, what we were noticing is in the lofts and in the studios, we were sensing some appreciation in that category, but in your 1s, 2s, and 3-bedroom units, we actually were pretty flat throughout the year, so not very much growth there. The one thing that I would note that was really interesting was when we did the fourth quarter survey, 8% of the respondents in the fourth quarter are now reporting that they are offering some level of rent concessions. So that's very interesting because we have not seen rent concessions for a long time in this market. Now, for most first-time Safari guests, they judge the quality of their safari based on whether or not they are able to view the Big Five. And the Big Five are the elephant, the lion, the water buffalo, the leopard, and the rhinoceros. They received that name back in the 1910, 1920 hunting safaris because these were considered the most ferocious animals in the savannah. Well, in 2015, in our Bakersfield multifamily market, we also had quality become a big issue. And that was especially true in the fourplex category. The fourplex category in Bakersfield makes up 75% of our market. And as you can see, in those buildings that would be considered an A and B location or A and B quality, they actually ended up having appreciation of 21.82% last year. So we certainly saw a trend of buyers moving towards the nicer quality last year. Now, the C and D fourplexes also had a very respectable year at roughly 10%. But the big surprise on this matrix is looking at actually the 5 units and above A and B buildings. The previous year, it had experienced 50% appreciation in that category, and yet this most recent year, they actually were the only category that had a negative 5.3 or 5.43 number. And then finally, the C and D 5 units and above, they barely eked out a positive, ending up roughly 2.1% appreciation rate. Now, in addition to seeing the big 5, the second most popular category of animals to see on safari is your little babies. And as you can guess, in the Bakersfield multifamily world, we also have new babies. And that would be our new construction. And for those of you who joined us the previous 2 years, you will know that new construction was kind of the centerpiece of my presentation, in that it had been the first time in a long time that we had had new construction here in Bakersfield. Last year, we had anticipated bringing 680 units online during 2015, with an additional 640 early in 2016. By the end of the year, we only ended up with 296 units open for business, and those are the 3 buildings that you see represented on the screen here. For a variety of reasons, the other buildings didn't finish construction, or in some cases didn't even start construction. And while I'm sure that that was a major disappointment to those developers, I can tell you that for those existing landlords, it was a welcome sigh of relief, because facing softer rents and increasing vacancies, they certainly weren't looking forward to having brand new competition out there. Now, long before Disney brought us The Lion King, the lion was known as the king of the jungle, and for good reason. Not only is he at the top of the food pyramid, but he lives a pretty amazing life. Basically, he gets to sleep all day while the lionesses do all the hunting. When they kill something, he's the first to eat until he's full. When he's feeling a little frisky, he actually mates every 20 minutes for 4 straight days. And about the only thing that he has to do that's distasteful is when somebody wants to take over his rule, he's got to run them away from the pride. But otherwise, he's got a pretty good life. So in the multifamily world, we actually had a new king of the jungle last year. I mentioned earlier the 8 transactions that had taken place in the 31 plus category. Of those 8 transactions, 1 investor bought 5 of the buildings, and he now joins a very illustrious list of major investors who have been active here in Bakersfield over the last 40 years. At the very beginning, I mentioned about the day-to-day survival. Unfortunately for the animals, they have to live in the moment. They do not have the luxury of planning for the future, but we in the multifamily sector certainly do. So going forward, I'm going to touch upon 2 of the issues that's probably most of the speakers will talk about today. The first one is the price of oil. When the price of oil goes down, unemployment goes up. And when unemployment goes up, it has one of 3 impacts on the multifamily market. The first being that you find people downsize in their units. The second one being that they will consolidate households, typically moving in with family and friends. And the last one is they actually relocate outside the area in search of employment opportunities. Obviously, none of those 3 bode very well for the overall sector. Our second issue is interest rates increasing. When the cost of borrowing money goes up, investors tend not to be willing to pay more money for purchases. And to give you an example, if we were to use the 2015 returns, an investor who saw interest rates go up 0.25% would look for a 1.75% decrease in value on their purchase price. And for those of you who like whole numbers, a 1% increase would equal a 7% decrease in your value. Once again, obviously something that could potentially have a negative impact on the multifamily. So with these 2 main issues in mind, I am forecasting that in the first and second quarter of 2016, we will probably have strong volume, as I feel a lot of buyers are interested in making acquisitions before interest rates go any higher. but we're probably going to have relatively flat pricing. And the reason for flat pricing is I think both the buyers and the sellers are going to be firmly entrenched in their pricing positions, and they are going to, both sides are going to dig in. So it will be interesting to see who prevails there. Assuming that we do have the interest rate increases, I would anticipate in the second half of the year we are going to have weaker volume, and we will probably see prices decline 3 to 5% by the end of the year. Now, I don't want to leave you today thinking that all is bad and woe is me for the multifamily world, but I think there are a couple of silver linings in our industry. The first being your first-time home buyer and those marginally qualified home buyers, they will probably have to delay their buying decision or buying process when interest rates go up. That will cause them to rent longer, which will lead to greater demand for rentals and consequently higher rental rates. And in the long term, I think that the multifamily sector will be probably the first real estate segment to recover. The second issue is the only reason people buy multifamily properties in Bakersfield is for the cash flow. Appreciation has been such a hit and miss issue over the last 30 or 40 years that our cash flow has always been king, and that is why people come to Bakersfield. That's why the locals buy multifamily. So with positive cash flow, that ought to be able to see us through these two issues and hopefully turn out to be a positive. So on behalf of Marlon, Jim, and myself, we want to thank you for joining our safari, and we look forward to seeing you in 2017. Thank you.
All right, so that was multifamily. Now it's time for single family. We're going to introduce Bill Redman, the broker owner of Watson Realty ERA and the 2016 Bakersfield Association of Realtors president. Mr. Redman began his real estate career at 26 years old when he worked as an appraisal assistant with his father, Stan Redman, at Prudential American West. His sense of discipline and loyalty is both nature and nurture, as his family and his 14 years serving in the United States Marine Corps and the reserves both instilled in him these virtuous traits. Thank you for your service. Today, he is the broker owner of Watson Realty ERA, San Joaquin Valley Mortgage, and Central California Escrow. He is actively involved in local, state, and national activities with the Realtor Association and presently serves as your 2016 president of the Bakersfield Association of Realtors. Bill Redman.
All right, let's get it started. So, how many here bought a house last year? Not that many. Okay. What about this year? All right. Well, here it goes. All right. I'm going to talk to you a little bit about the state of California, what's happened with the state, and then I'm going to go into the Central Valley, what we experienced in 2016, and then I'm going to talk to you about here locally and what you can expect, or what I think, and then I'm going to tell you who's going to win the Super Bowl. So. The economy has been growing for the past 6 to 8 months, and you can see we had on an annual basis from 2014 we had a 2%, 2.4% in 2015, 2.4%, and in 2016 2.6%. Key factors that affect the macroeconomy are consumer sector, your business sector, your government, and international trade, which is down. Okay, employment stalled in September at 142,000. Now, I want you to realize some of this information I'm giving you today. Leslie Appleton Young, who is the chief economist for the California Association of Realtors, gave a talk to us. And a lot of this information I'm giving you today was from that talk back in October. There have been some changes, and I'll make note of those changes also. So employment stalled in September from 198,000 in 2014 to 266 per month in 2015. Unemployment rates we hold steady, as AJ said earlier. U.S. is at 5.1. August is at 6.1 currently. Job trends by California metro area. You can see in the Bakersfield area we had a slight decrease with a negative 2% growth. Non-farm employment by region. We see Southern California had a 2.4% increase. Bay Area with 1.8. Central Valley had a 3.2% change. Mortgage rates, we had a slight increase in rates like they stated earlier, my previous speakers stated earlier. They're talking about rates increasing throughout 2016 with a couple of adjustments throughout the year. You know, how many here last week got really, really scared when everything started dropping in the stock market, you know, and so everybody was talking about the interest rates making an adjustment again here in the next week. It's funny. I ran into a broker who has been in the business for a long period of time, and I ran into her at the store over the week, and she said, yeah, the interest rates are going to go back down. You know, we had an adjustment in December, and they're going to go back down. Well, I just signed loan docs on Friday for a refi. So I was all, well, I got screwed there. So I hope she's not right. Anyway, so mortgage rates. So we said the rate hike was like in October was postponed, but not canceled. They actually was. They did have the adjustment in December. Factors for the delay, why it was delayed, was a global economic slowdown, stronger dollar, emerging markets vulnerable to the rising rate environment, heightened stock market volatility, negative wealth effect could lead to a slowdown in economic growth, and avoid a repeat of the taper tantrum that had not articulated enough on all the moving parts and did not want to give any surprises. Where are we headed? Well, like we said, Fed will likely begin normalization in December, which they did, and rates will gradually increase in 2016 and 2017, and action will be data determined. Risk of rates increasing too fast, bringing economic growth to a halt. Risk of rates increasing too slow. Zero leverage when the next downturn hits. So, U.S. home sales were up in 2015, and in August sales were over 4 million units with a 8.1% year to date with a 6.1 year to year. U.S. home price gains and moderating in August 2015, 230,000 with a 1.4% month to month with a 5.1% year to year. California housing market outlook. 2015 sales did not disappoint. We had a good 2015 as far as housing sales. California August 2015 sales 431,000 units with a 7.4% year to date and 9.3 year to year. California sales regained momentum in 2015. Year over year percentage change 6 per moving average, year over year percentage change. So you can see the change there. Home price gains have slowed. We've seen a considerable slowing down since about August. We've seen the prices slow down. We had a little bit of a dip here on the local market, and right about in August to September, we had about a 10% change in values where they slowed, and then the inventory increased. Here we go. Home price appreciations moderated since mid-2013. Okay, so the housing market has recovered. Welcome to the new normal. Low mortgage rates. We still have low mortgage rates. Job and income growth are positive, and yet supply will be long-run average. Share of first-time home buyers are low, and I'll talk about that here shortly. Affordability, key concern for everyone. Now, affordability on a state level is a major concern. You go to San Francisco, Silicon Valley, and so on. Yeah, there's a big problem there of purchasing. Not so much in Bakersfield. The one factor of Bakersfield, in the city of Bakersfield, is the employment issue and what's going to happen with oil. Underwater mortgages, starting to gain some equity here. So, and you can see how the negative equity has sharply declined. Okay, so this is the California August 2015 median prices year to year. You can see Kern, 225,000, and then we got the sales, 2% increase in Kern. Here's the Central Valley. Sales, 10% year to date. 12% year to year. Median price, $276,900. 7% year to year. We have a month supply, 3.6 month supply. So, and the sales, 97%. So when they list it, pretty much 90% of what they list it as what it's going to sell at. Here's the Central Valley median prices. Take a look. 225,000, 4.8. And then sales, year to date, 2015. Residential sales, City of Bakersfield. So this is what happened in City of Bakersfield. For 2014, we had 14,361 sides. So, as agents, we calculate sales by sides. You have a listing side and a selling side. So these are the number of sides that took place in 2014. In 2015, you can see there wasn't that much of a difference. We had 14,770. With a percentage change, we had a 2.81% increase in number of sides that sold. Now here we go with value. Average price in the City of Bakersfield. 2014 was $210,514. In 2015, it went up to $220,562, with almost a 5% increase year over year. 2016 forecast. Yeah. Okay. California housing market outlook. This is for the state of California. We single family home sales was 407 with a projection of 2016 of 433. Percentage change from year over year, a little bit over 6% is what we're projecting for 2016. Median prices for the state, 476, 491. That's on a state level. Percentage change, a little bit about 3% state over the state. Housing Affordability Index. As a director with CAR, one of the biggest things they talk about is the housing affordability and the ability of new home buyers coming in. Talk about that in the millennials. They got a real problem with millennials because they're not out there buying like they should. They're all staying at home with you guys. So we got to do something about it. All right, kick them out. 30-year firm, so at 4.5%. Sales up for 2015, price will level with an increase. 10.4. Sales up for 2015, price will level with an increase in inventory this year. We're going to see we're going to see an increase in inventory. Prices are staying on the market a lot longer. So for those of you that are thinking about buying this year, it's a great time to buy because the inventory is increasing. I got, as a broker, as a real estate broker, I deal with what I call agent issues. And those are agents that don't talk to their sellers when their house is listed. And I'm getting a lot more calls because the houses are staying on the market longer. So you're going to see an increase in volume there. California dollar up. So stronger dollar like AJ was talking about. Wild card, stock market volatility, slower growth in China, further collapse in energy and commodity prices, geopolitical tensions, terrorism, believe it or not, El Nino, water shortage, and the 2016 presidential election are all factors. Market trends, real quick. This will give you just a snapshot. This is City of Bakersfield for 2015. You can see our the light green is actually inventory. The red line is the pending, which follows the solds, and you can see how we've been acting for the last couple of years. Price per square foot sold, $127 per price per square foot. List price versus original sales price, 90%. I said 97 here in City Bakersfield. It's about 96%. So if you list your house with an agent, you can figure 96% of the time, you'll get 96% of what you actually listed at. A lot more negotiating going on out there. A lot more buyer incentives. So if you're listing your house with an agent, be prepared Here the inventory. Now it shows like there was a decrease in inventory. We had in November we had a huge increase. We had the market stalled a little bit in August. Increase in November. In December it dropped, but we had more houses come on the market. Less houses come on the market, and the pendings stayed the same. Market opportunities in 2016. Millennials turn renters into first-time home buyers. First-time buyers who bought with a tax credit back in 2009 are ready to trade up. Understand the differences in needs between millennial first-time buyers and millennial trade-ups or trade-up buyers. Baby boomers are ready to downsize, understand boomers' priorities, investments, and retirement. If we can't keep them in California, help them find a place at our state network realtors. That's what she said. All right, minorities are a key factor in here in our because of the affordability. Minorities have grown into a high home buyer share with over time. Surge in the number of minority households will play a big role in the increase in the housing demand in the next 10 years. Develop programs and marketing material tailored towards minority homebuyer programs on different ethnicity. Investors, sellers, investor buyers who purchased bargain properties a few years ago are ready to sell as home prices start leveling off. Everyone else, low interest rates will be here a little longer. They're projecting for the next 12 months at least. Most millennials are uncertain and doubtful that they could even obtain. So education is key on the millennials. So 45% of them don't even know. Okay, my last prediction for 2016. Broncos will win the Super Bowl. Thank you very much.
Two more before our break. We're going to have a little switch with the break, so we have just a little bit more before your bathroom stop. We're now time for industrial, introducing John Ritchie, the Senior Vice President of Newmark Grubb ASU and Associates. Mr. Ritchie spent the early part of his career as an industrial property specialist for CBRE before transitioning into real estate development in 2000. As VP of Commercial Development with Jayco Oil Company, he completed phases 1 and 2 of the Northwest Promenade Shopping Center. My wallet thanks you for that. My husband does not. He has also been involved in entitlement and in construction of the Super Walmart centers at Panama and Highway 99 and Gosford and Pacheco, as well as many other retail property development sites. After coming VP of Roll Real Estate Development, Mr. Ritchie developed Crossroads Business Park, North Meadows Industrial Park, Paramount Logistics Park, and the acquisition of 10,000 Ming Avenue. Mr. Ritchie is a graduate of Cal Poly SLO with a bachelor's in Business Administration Finance and is a lifetime resident of Bakersfield. John Ritchie.
That working? There we go. Thank you for that. Been very lucky in my career to be surrounded by a lot of smart guys. And in looking at our industrial real estate market, we have to look at what has happened in the past, what's going on in the present, and how we can predict the future. Probably one of the main factors that we looked at is that the industrial market as an overall market for the last 5 to 7 years has slowly increased. It has regained its position as one of the stronger segments in the commercial market. We've seen vacancy levels drop to all-time lows. We've seen per square foot prices increase, especially in the major metropolitan areas where there's been tremendous growth especially driven by the retail markets. Industrial real estate has gained a position in the investment world as one of the top and most safe investment placements that you can have. Over this last year, the Amazon effect has really taken hold in that other distributors, other retailers are forced to adopt the Amazon marketing and delivery schedules, which has caused a need for additional warehouses and distribution centers. E-commerce center has really changed the way the world works. The Amazon effect is something that's truly unique in our market in that e-commerce has but really gained a position in regular traditional retailers. E-commerce growth outpaced in-store sales 5-1 over this last year. Consumers demanded from their retailers that they were able to get products in a delivery schedule such that Amazon could deliver that day, next day, prime service. The inventory and locations for distribution changed dramatically as mega distribution centers started to add additional smaller units close to major metropolitan areas to facilitate that next day deliveries. E-commerce touched Kern County last year with the opening of the Ross Dress for Less, 1.7 million square feet, 160 acres, averaging 150 employees. The location in Shafter was mainly because of the proximity to the LA market, distribution, ability to distribute to close to 40 million people in a one-day delivery schedule, proximity to the port, our great Kern County employment base that we have that can fill a 1,500 job employer, and fully entitled land for sale. That probably is a key that we have to continue to look at, is that as a community we have fully entitled land that is available for not only this last wave of industrial growth, but the next wave of industrial growth. Future satellite centers will start to come around Kern County. We've seen some activity where we'll have smaller versions of the mega centers come in for the next day deliveries. So as we look at 2015 from a micro standpoint, where we've been, 15, I believe, is the apex of a long 5-year growth span that had oil and ag hit record prices. I need to keep up with myself here. The building vacancy over the last year has dropped down below 3.5%. E-commerce came back into Kern County. Nordstrom's located in Fresno, committed to a Fresno location for e-commerce distribution fulfillment centers as well. Speculative building resumed, something we hadn't seen in several years. The inventory of buildings for sale and lease, finished lots, has driven our market into a level where we've really not seen it. We've got a couple of industrial parks coming online with the landings, which will be active in 2016 up by the airport, Silver Wings in 2016, 2017, a couple of other large industrial parks planned in the Enos Drive area as we go forward into 2017, 18, and 19. What this is going to do is we're going to see our historical finished lot prices, and that's, for me, the basis of how it affects our retail leasing and rental rates. So we've seen a decrease in land prices going down to what we would call our crisis center in about 2008, 2009, rapidly increasing to 2015. So as far as forecasting what we're going to see from 2016 and beyond, in looking at different forecasters, different market trends, we're seeing that there's a mixed opinion out there. There's so many variables to consider, and it seems like we are approaching a trend that we've been before. So in forecasting 2016, I look at many different forecasters. We're seeing that their accuracy is varied across the board. So I'm going to go with a few famous ones at first. Successful forecaster, Groundhog Day. This guy gets it right 40% of the time. He gets his own day. He's on the morning show. Okay, well esteemed. Secondly, we always look at our economic forecasters. In doing research for this speech, I got 100 different opinions of what's going to happen. The key thing to know is that out of the last 3 recessions, these professional economists predicted it with 6% accuracy. So based on that, I think I've got a pretty good shot of getting close. So my forecast for 2016 is that we have reached the peak, 2015. We are now entering our bear market. Not really going to be this kind of a bear. It's going to be this kind of a bear. Okay? We're going to see different worldwide economics start to really take effect, especially as we get towards the end of the year. The China issue, our oil surpluses, Iran coming on with close to 1 million barrels per day by the end of the year, the US dollar affecting our commodities, high debt levels, and a worldwide recession will have a cumulative effect that will slowly start to erode some of the things that have kept us going. In looking at real estate prices, I can see a slow decline into 2019 until we resume, until some of those international issues start to work themselves out, and we'll start another climb. So this reminds me a lot of what we had entering into 2010. I think this reflects about where we'll be in the next couple of years, which is the ability that the international things will have rectified themselves, some of the oil surpluses will have played out, and we'll start getting into a period where we can recognize building trends coming through. We'll see new developments occur. We'll be prepared for the turn. So the turn happens gradually over into 2019. So in today's market, the forecast is, what do we do in the meantime? Do we wait, ride this down, wait for the bottom, look across 5 years through the valley and see that we're at the same price level or the same amount of equity that we have today as we will in 5 years? Or you can take a proactive step and look at buying and developing longer term assets, finding value add assets, and investing in real estate that will have a longer hold period that will survive this dip. So over the next 12 to 18 months, I see real estate values start to drop. Our momentum in the overall real estate market will push us through while other factors and industries, commodities start to drop. Will start to fall off by the end of 2016. The investment value will still hold some strength as foreign dollars will continue to flow into Kern County in the United States as the last resort. They're fleeing their own countries, and we still will be a safe haven. So the real estate market will succumb eventually to the world recession. However, we will still be an overall strong performer. So my 8 final takeaways. I think that you need to act now, preserve your equity. We have some clients now that are considering sale leasebacks, where they're selling their properties today, taking advantage of a strong investment market, and are leasing back, taking that equity, moving into another property that may have appreciation, maybe outside of a commodity-driven market, where they can realize continued appreciation over the next 5 years. There is a lot of money to be made in a down market. Selling and reinvesting in other geographic areas is one play. Investing in long-term projects. Creating cash today for price decreases and deals that will happen in the next 3 to 5 years. So there's a short window in the real estate market, I think, in the next 12 to 18 months to get your ducks in order, plan for the future, plan for the inevitable downturn, and be prepared for it. This will be, investment real estate will be the safest spot to go, but we have to plan for it and not just let it ride out. That's my prediction. Thank you.
All right, so here we have a little switch in our program. We're going to jump ahead to water. And this is a new exciting topic for this year because, as we know, with the drought, a lot of focus for several different industries has been on water. Just as a forecaster, a quick update for you. With this El Nino season so far, Bakersfield is only 79% of average for our water year since October 1st.